The debt trap is not just borrowing money. That is the first thing everyone gets wrong. Borrowing money can be useful, dangerous, necessary, strategic, careless, or unavoidable, depending on the situation. A mortgage is debt. A student loan is debt. A business loan is debt. A credit card balance is debt. A medical bill on a payment plan is debt. A car loan is debt. Buy now, pay later is debt, wearing a tiny hat and pretending to be a checkout feature. So the problem is not simply debt exists. The problem is what happens when debt starts making decisions for you. That is the trap. My name is Cash Cat, and I spend way too much time thinking about money, the fish bank, the mouse market, and why people can work harder, earn more, make payments every month, and still feel like they are sinking in slow motion. The debt trap no one explains clearly is this. Debt takes money from your future paychecks, adds a fee for the privilege, and then leaves your present self with less cash, which makes you more likely to borrow again. That is the loop. Future money gets pulled into the present. The present becomes short. The shortage creates more borrowing. More borrowing claims more future money. Then the next paycheck arrives already wounded. And because the whole thing happens gradually, people often do not realize they are trapped until the payments have become part of the walls. Let us start with a simple example. Imagine you have $1,000 in monthly breathing room after your basic bills. That $1,000 is powerful. It could build the fish bank buffer. It could pay for repairs in cash. It could go into the mouse market. It could cover life without panic. But then you take on a $400 car payment. Now your breathing room is $600. Then a credit card minimum becomes $150. Breathing room is $450. Then a phone payment and a buy now, pay later plan add another $120. Breathing room is $330. Then groceries rise, insurance rises, or your hours drop. And suddenly the $330 is not enough. You use the credit card to cover the gap. Now the debt grows. The next minimum payment rises, and the breathing room shrinks again. That is the trap. Not one dramatic mistake, but a narrowing hallway. At first, you can turn around. Then it gets tighter. Then you are still moving, still making payments, still working, still technically functioning, but every month has less space than the month before. This is why debt can feel so confusing. People think, I am paying. Why am I not getting ahead? Because payment and progress are not the same thing. This is one of the most important financial sentences you will ever hear. Payment and progress are not the same thing. You can make payments for years and barely improve your position if the interest, fees, and new borrowing keep replacing the balance you paid down. That is why minimum payments feel so cruel. They create the emotional experience of responsibility without necessarily creating much freedom. You pay the minimum, the account stays current, your credit may survive. You avoid the immediate pain, but the balance can remain stubborn, especially if the interest rate is high and the card keeps getting used. The minimum payment is not evil by itself. Sometimes it keeps you alive during a hard month. But if minimum payments become the long-term plan, the lender is much more patient than you are. That is a problem. Because debt companies understand time. They understand that a small monthly payment feels manageable. They understand that people are stressed. They understand that total cost is abstract, but monthly pain is concrete. They understand that if the payment fits, many people stop asking what the debt will cost over its full life. This is the same trick everywhere. Do not look at the total. Look at the payment. The car is not $55,000. It is $720 a month. The furniture is not $3,000. It is $89 a month. The phone is not $1,200. It is $33 a month. The vacation is not unaffordable. It is 6 easy payments. The credit card balance is not a crisis. It is only the minimum due. This is how debt makes expensive things emotionally smaller. But the math does not become smaller. It just becomes harder to see. Now, people often talk about debt like it is a character flaw. Like, if you have debt, you must be irresponsible, undisciplined, or bad with money. That is not only unkind, it is often inaccurate. Debt enters people's lives through many doors. Sometimes it enters through emergencies. Your car breaks and you need it for work. The fish bank is empty, so the card becomes the emergency fund. Sometimes it enters through medical costs. Something happens, and the bill does not care whether the timing is convenient. Sometimes it enters through unstable income. You were fine until hours changed, commissions dropped, clients disappeared, or a job ended. Sometimes it enters through family. You help someone because not helping feels impossible. Sometimes it enters through social pressure. Weddings, holidays, school events, moving, clothes for work, things that feel hard to refuse without exposing your situation. And yes, sometimes it enters through wanting things now. A trip, a gadget, a lifestyle, a version of yourself that feels just a few purchases away. Different doors, same machine. Once debt is inside, it starts charging rent. That rent is interest. Interest is the price of using future money early. When the interest rate is low and the purchase is productive, that price might be reasonable. When the interest rate is high and the purchase is already gone, the price can be brutal. This is why credit card debt feels different from a mortgage or some business loans. With a mortgage, the debt is tied to an asset that may hold or increase value. With a business loan, the debt might create income if the business works. But with high-interest consumer debt, the purchase often disappears while the balance remains. The dinner is gone, the clothes are old, the vacation is a memory, the emergency is over, but the payment stayed. That is emotionally exhausting because you are using today's energy to pay for yesterday's pressure. And if today's money is already tight, paying for yesterday can create tomorrow's debt. That is the loop again. Now let us talk about shame, because shame is part of the trap. Shame makes people hide the numbers. They avoid opening the fish bank app. They avoid credit card statements. They avoid adding up balances. They make the minimum and try not to think about it. They tell themselves they will fix it when they earn more, when life calms down, when the next bonus comes, when the next month is normal. But debt loves being vague. Vague debt feels like fog. It is scary, but you cannot fight it directly. Clear debt may feel painful at first, but at least it has edges. You can see the balance. You can see the interest. You can see the minimums. You can see the order. You can make a plan. The first step out of the trap is often not paying. It is looking. That sounds simple, but it can be emotionally difficult. Opening every account, writing down every balance, every interest rate, every minimum payment, every due date. This can feel like walking into a room you have been avoiding because you know there is a mess inside. But here is the twist. The mess is already there, whether you turn on the light or not. Turning on the light does not create the problem. It gives you a chance to stop bumping into it. Now, once you see the debt, you need to understand what kind of trap you are in. Not all debt problems are the same. The first type is cash flow debt. This happens when your income is close to your expenses and small gaps keep going on credit. The balance grows not because of one huge purchase, but because life costs slightly more than your available cash. Cash flow debt is dangerous because it feels like normal life. Gas here, groceries there, a bill before payday, a small emergency. Nothing looks wild, but the card balance rises slowly. The solution is not only paying the card, you have to fix the gap. If the gap stays, the card refills. That may mean cutting a fixed expense, increasing income, changing due dates, building a small buffer, or all of it. But if you attack the balance without fixing cash flow, it is like mopping the floor while the sink is still running. The second type is event debt. This comes from a major thing: medical bill, job loss, divorce, move, family emergency, car repair, funeral, disaster. Event debt can happen to responsible people because life is not impressed by responsibility. With event debt, the key is containment. You do not want the event to become a lifestyle. You need a plan that keeps the debt from spreading into every other part of your finances. That might mean negotiating, setting a payment plan, prioritizing high-interest balances, and rebuilding the fish bank so the next event does not land on the same card. The third type is lifestyle debt. This is debt used to support a life that income cannot actually support. This one is emotionally tricky because the purchases may feel tied to identity. The apartment, car, trips, clothes, restaurants, gifts, subscriptions, and social habits all feel like normal life. Lifestyle debt requires honesty. Not cruelty, honesty. If your life requires debt to continue, then the lifestyle is not affordable yet. That sentence can sting, but it can also free you. Because once you admit the lifestyle is too expensive, you can stop blaming yourself for not magically catching up. The math never allowed it. The fourth type is hope debt. Hope debt is when you borrow because you believe a better future is right around the corner. You put things on the card because the raise is coming. You finance something because the side hustle will take off. You take a loan because next month will be easier. You use debt as a bridge to a version of life that has not arrived yet. Sometimes hope debt works. Sometimes the raise comes, the business grows, the bonus hits, and you pay it off. But if the better future keeps moving, hope debt becomes dangerous. You are not borrowing against a plan anymore. You are borrowing against a feeling. And feelings do not make payments. Now, how does the trap actually tighten? First, debt reduces cash flow. More payments mean less money left. Second, reduced cash flow makes emergencies harder to handle. Third, emergencies go back onto debt. Fourth, the balances rise. Fifth, minimum payments rise. Sixth, stress rises. And seventh, stress makes clear thinking harder. Eighth, unclear thinking creates more short-term decisions. That is the machine. Notice how moral failure was not one of the steps. The trap is mechanical and psychological at the same time. Mechanically, interest and payments reduce your options. Psychologically, stress and shame reduce your ability to act early. Together, they make debt feel heavier than the numbers alone. This is why a debt payoff plan has to protect your brain, not just attack the balance. If the plan is so extreme that you feel deprived, ashamed, and exhausted, you may quit. If the plan ignores emergencies, the next emergency sends you backward. If the plan does not include a small fish bank buffer, every surprise becomes new debt. If the plan does not address why the debt formed, the balance may disappear and return later wearing a different outfit. So what does a clear plan look like? First, stop the bleeding. This means identifying whether new debt is still being created. If credit cards are still covering monthly gaps, the emergency is not the balance. The emergency is the gap. You need to create even a small amount of breathing room before payoff can stick. That might mean cutting one meaningful fixed cost, selling something, pausing non-essential spending, taking temporary extra income, or changing bill timing. Not forever, long enough to stop adding new debt. Second, build a starter buffer. Some people hear this and say, why save while in debt? Shouldn't every dollar go to the balance? Mathematically, high-interest debt is urgent, but behaviorally, a small buffer can prevent the next surprise from going right back on the card. Even $500 or $1,000 at the fish bank can change the pattern. It is not a complete emergency fund. It is a shield. A small shield, but still a shield. Third, choose an attack method. There are two classic ways people think about this. One is paying the smallest balance first for motivation. The other is paying the highest interest rate first for mathematical efficiency. Both can work. The best method is the one you will actually follow long enough to become free. CashCat cares about math, but CashCat also cares about humans. If knocking out a small balance gives you momentum, that momentum has value. If you are highly motivated by saving the most interest, attack the highest rate. The key is that extra money goes somewhere on purpose, instead of being sprinkled around randomly. Fourth, do not trust freed payments too quickly. When you pay off a debt, the old payment feels like new money. This is a dangerous moment. Your brain wants relief. It wants a reward. It wants to breathe. And some breathing is good. But if the full payment gets absorbed into lifestyle immediately, the debt payoff loses power. The move is to redirect most of that old payment to the next debt, or to the fish bank if the emergency fund is too small. This creates a snowball effect. One payment disappears, then helps attack the next. Then two freed payments attack the next. The machine starts working for you instead of against you. Fifth, make debt harder to recreate. This is where people skip the deeper work. If debt came from emotional spending, you need friction. Remove saved cards, delete shopping apps, wait 48 hours for non-essential purchases. Create a fun money category so your brain does not rebel. If debt came from irregular expenses, create sinking funds. If debt came from low income, the plan may need an income component. If debt came from social pressure, practice honest sentences. I am not doing that right now. That is not in my budget this month. I am focusing on paying things off. You do not owe everyone a spreadsheet, but you may need to stop pretending. Pretending is expensive. Now let us talk about consolidation, because this is one of the most misunderstood parts of the debt trap. Debt consolidation can be useful if it lowers interest, simplifies payments, and comes with a real behavior change. But consolidation does not erase debt, it rearranges debt. If you consolidate credit cards into a loan, then run the cards back up, you now have the loan and the cards. This is how people accidentally make the trap deeper while feeling like they were being responsible. The emotional danger of consolidation is that it creates relief before the problem is solved. The balances look cleaner, the payment is organized, the pressure drops. And that pressure drop can trick your brain into thinking the danger has passed. But the danger only passes when the debt is actually shrinking and not being replaced. Balance transfers can have the same issue. A lower interest rate can help, but if the transfer becomes permission to keep spending, the math improvement gets eaten by behavior. Again, this is not about shame. It is about matching the tool to the truth. If the truth is, I need lower interest and I have stopped adding debt, consolidation might help. If the truth is, my lifestyle still costs more than my income, consolidation is just moving furniture in a burning room. Now, what about good debt versus bad debt? People love this distinction, and it can be useful, but it can also be oversimplified. Good debt is usually described as debt that helps you buy or build something valuable: education, a home, a business, maybe an asset. Bad debt is usually high-interest consumer debt for things that lose value or disappear. But the real question is not whether debt sounds good in theory. The real question is whether the debt improves your future cash flow or weakens it. A student loan can be good if it leads to higher income and manageable payments. It can be crushing if the cost is high and the income does not follow. A mortgage can be reasonable if the payment fits your life. It can be a trap if it leaves no room for repairs, savings, or breathing. A business loan can be smart if the business has real numbers. It can be hope debt if the plan is mostly vibes. A car loan can support your income if it gets you to work reliably. It can destroy your progress if it is mostly identity transportation. Debt is not good because it has a respectable name. Debt is good only if the future it creates is stronger than the payments it demands. That is the clear explanation most people do not get. Debt is a trade between present access and future flexibility. Every debt asks, do you want this now badly enough to give up some choices later? Sometimes the answer is yes. Sometimes it should be no. The trap happens when people stop feeling that trade. They see only the access and ignore the flexibility they are giving up. And flexibility is everything. Flexibility is the ability to change jobs. Flexibility is the ability to survive a bad month. Flexibility is the ability to invest in the mouse market. Flexibility is the ability to say no. Flexibility is the ability to take care of yourself without asking a lender for permission. Debt reduces flexibility. High-interest debt reduces it aggressively. That is why paying off debt can feel like getting part of your life back. It is not only the balance going down, it is the return of choices. When a credit card payment disappears, the paycheck has more room. When the car loan ends, the month gets lighter. When old buy now pay later plans stop hitting, the calendar feels less crowded. When the fish bank starts growing, the card stops being the emergency fund. When money begins moving into the mouse market, the future starts receiving something instead of only the past. That is the path out. Not glamorous, not instant, but real. Now, if you are deep in debt, here is what I do not want you to do. Do not decide that because you cannot fix it in 1 month, there is no point. Debt traps are built over time and usually escaped over time. The first win may be simply not making it worse. That counts. A month where the balance does not grow is progress. A month where you use the fish bank buffer instead of the credit card is progress. A month where you say no to a purchase that would have become debt is progress. A month where one small balance disappears is progress. A month where you finally know the real numbers is progress. Do not let the size of the mountain convince you that the first step is meaningless. The first step is where the direction changes. And direction matters more than drama. The debt trap no one explains clearly is not that borrowing is always evil. It is that debt can quietly turn your future income into past payment obligations, then leave you too cash poor to avoid borrowing again. Once you see that loop, you can start breaking it. Stop the bleeding. Build a small shield. Pick a target. Redirect freed payments. Make new debt harder to create. Tell the truth about the lifestyle, the emergency, the income, or the pressure that created the debt in the first place. And most importantly, stop confusing payment with progress. Progress means the balance is shrinking. Progress means cash flow is improving. Progress means the next emergency has a chance of landing at the fish bank instead of on a credit card. Progress means your paycheck is slowly becoming yours again. That is what freedom from debt really means. Not perfection, not never borrowing again under any circumstances, and not judging everyone who has a loan. It means your money is no longer permanently dragged backward. It means your future self gets to keep more of what they earn. It means the mouse market can start working for you because the past is not taking every dollar first. It means the fish bank becomes a real safety net instead of an empty waiting room. It means you can breathe. And once you understand debt that way, clearly, without shame and without fog, the trap becomes less mysterious. It is a loop. And loops can be broken. One honest number, one protected dollar, one payment, one no, 1 month at a time.